Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel. We get a lot of questions about individual bonds. If you listen to us regularly, you know that we like to buy individual bonds more so than buying bond funds. Bond funds aren't necessarily bad, but you do have to worry a little bit about fluctuations in value when interest rates change. Whereas when you own individual bonds and hold them to maturity, interest rate fluctuations don't really matter at all because we are just buying the bond, collecting the interest payments on the bond, and holding it until the bond matures. And we match up those maturity dates with when income is needed for our clients. We always say to have at least the next 5 years of income tied to these individual bonds with varying maturities to match up to when you need that income. So that's a pillar of how we structure investments and planning for our clients. And we use these individual bonds to make sure that this all goes properly and it all continues to go well. But we sometimes and fairly often get questions about the coupon interest rate on the bond. And I'll explain what that means in a second. Because if you look at an account statement, you might see Company A pays Company A bond at 2%. And then on that next line, you might see Company B bond at 7%. And we'll get the question of, why do we have this bond that only pays 2%? We're only making 2% on this bond. And this other bond is paying out 7%. This is amazing. Why in the world would we have this 2% bond? We can get a better rate of return on that in a lot of different places. But the 7% is amazing. The reality is those two bonds could be paying out the exact same amount in the end. It might be slightly different, and one might still pay out more, one might still pay out less, because that coupon rate is not the only factor and how much you are making off of the bond. That coupon rate is a reflection of what gets paid out in interest every 6 months. So if you have a 7% coupon rate, that means 3.5% interest gets paid out every 6 months until the bond matures. But there's more to it than that. Because when a bond prices, when it first starts out, it starts out at what's called par, which is $100 per bond. It will also mature or end, it's called maturing, at par. So it's always going to start at 100, end at 100, unless there's some sort of problem with the company where they can no longer pay out the 100. And that's a bigger issue, but that's really why we stick with really, really high quality bonds. We don't want to be in a situation where it doesn't pay out at the end, if at all possible. Now, could you invest in a double A or triple A or even maybe a single A bond and something happens with the company and that doesn't pay out that par value at maturity? Sure, but it's unlikely. If you're in that triple A, double A space especially, it's highly unlikely that they're not going to be able to pay back the debt. That's how they got that high rating in the first place, is they have a very high likelihood of paying out that par value at the end. And that's what we are focused on. It's less about how much the interest rate is. We do want to make interest. We definitely want to make interest, but we're more focused on we need that money back for income over the next 5 years. So it starts at par and it ends at par. Now, the value in between those two can fluctuate up and down with the changes in interest rates. Now, we don't care, once we've purchased it, we don't care really about the fluctuations in value as long as everything's still okay with the company. If the value drops because the company's in trouble, different story. But again, we're doing high quality bonds. So little fluctuations in value over time, they just don't matter. If we buy the bond and we know it's maturing at 100, that's all we really care about. It can bounce around in between all at once, and it will bounce around a little bit with changes in interest rates. Now, we say all that in terms of starting at par, ending at par, and you might buy it at a different value in between. And we point this out because that value in between where you purchase it, because you're not always purchasing it when it gets issued right away. Sometimes you're purchasing it midlife. It might be a 5-year bond and you buy it in year 2. You could buy it right at the start. You could buy it year 1. You could buy it year 4. You can buy it anywhere in between. And the value that it is at that time is going to depend a lot on what the interest rate environment is now versus when it was issued. So let's run through an example of that. Let's say the company issues a bond at 2%. So the interest rate overall, interest rates are very low. We had low interest rates for many, many years. So a company could issue a bond and only have to pay 2% interest on it, which is great for the company. That doesn't happen too often. You have to be a really high quality company to do this. But let's just, for example's sake, say this company issued bonds at 2%. Well, then what happened is interest rates start to rise. And now that bond that you bought that's paying out 2% isn't worth as much anymore, because now somebody else can go get a different bond that's paying out a higher interest rate. So that 2% bond is now trading at a discount. It's not going to trade at the $100 par that it started at. It might trade down to $97 or $96. So for this example, we'll just say 97. We'd say it started at par at 100. Now it's down to $97 at a discount because interest rates overall have gone up. And people are saying, we don't want to buy your 2% payout. This one over here is paying out 4. Now yours is worth less. If we're holding to maturity, not a big deal, because we know that it's going to go back up to 100 at maturity. So let's say that we are the one coming along. Somebody else has this 2% bond and it's trading at a discount. We want to come along and buy that. We know that we're going to get a 2% coupon payment each year. So it's 1% every 6 months. But we also know that we are buying it at 97 and it's going to go up to 100 when it matures. So we're going to get that $3 difference also. The rate of return that turns into is going to depend on how long you are holding it until maturity. If you only hold it for a year, well, then you're going to be making over 3% on that $3 because you bought it at 97. So you're making over 3% on that $3 plus the 2% interest. So if we're buying things at a discount, we get that gain up to 100 plus the coupon. Now that example shows you where somebody might look at this bond and go, what in the world? We're only making 2% on this bond? You can say, no. That 2% is the interest payment. Add to that the $3 difference that we make up when it goes from 97 to 100. That gives us our rate of return, depending on how long that time period is. So it's more than just the coupon that you see on the statement. That is just what it initially started at. Buying it at a premium or a discount impacts what your actual payout is over that period of time that you're holding the bond. Conversely, let's say somebody issues a bond at 7% because interest rate environment's really high at this point in time. Let's say it's 7% interest when it gets issued. But then interest rates overall decline. Let's say 2 years later, the interest rates are a lot lower and a new bond gets issued at 4%. Well, this one's still paying out 7. So everybody wants the one you have because it's paying out 7. Now your bond is trading at a premium. It's not at the $100 par anymore. It might be at $104. So if we come along and buy it, we're going to pay 104 and we're going to get this 7% interest each year. So 3.5% every 6 months. We're going to get that 7% interest, but we have to account for the fact that we are going to lose $4 difference from 104 down to 100 over time until it matures. So we're not making a 7% rate of return on this. We're going to be making something less when we lose that $4 difference between where we bought it and par when it matures. So anytime you're looking at an account statement with individual bonds on it, or you see the individual bond has this amount of a coupon, that's only a piece of the picture. That coupon is the interest payment you'll receive every 6 months. We have to determine, is it trading at par? Is it trading at a discount? Or is it trading at a premium? Because those are the factors that really determine what the ending rate of return is as we are holding it to maturity. So we have to go over that question with people from time to time, because it's very easy to look at the bond and see the coupon rate and go, oh, that's an awful rate of return, or that's an amazing rate of return. And in the end, they could very well be the same rate of return because you have to factor in either the discount or the premium. I hope that helps explain how these individual bonds and bond pricing works, especially if you're trying to do that on your own. It could be pretty tricky, but it's not impossible. So just understand what price you are buying the bond at is going to have a big impact in that overall rate of return when you either add it or subtract it from the coupon payments that you will receive on that bond over time.